With over 3,000 stocks available to trade at the stock market, there's always this dilemma: which stock should I buy? Which stock should I add to my portfolio? So today I'm going to make it simple for you and show you 7 stocks based on my analysis that you could potentially buy in the month of Feb of 2022. So let's get started. So the first stock that I have on my list is Apple. Now this could be common sense. Like, you ask anyone, they would probably tell you you should buy Apple. But it's not just the name and the brand that's important, but you also got to look at the fundamentals and the technicals to know, is it a really good investment and is this the right time to buy Apple? So let's dive into it and see, is this a right choice for us in the month of Feb? Now let's look at the fundamentals and see why exactly have we picked Apple. Now, if you look at the Apple fundamentals, you will notice that the earnings per share is at 6.12. Now, that's a good sign for a stock that is anything above 2 is a good sign for a healthy stock. So the earnings per share gets my check mark. The PE ratio is at 28, and my line would be around 9, anything above 9. But comparing it to other stocks in the same sector, 28 is still a good time to invest. It's not overinflated like some are at 60, and that's a dangerous sign. You should never invest in something that high. Now, the dividend yield is at 0.50. Now, this is not a dividend stock. This is something that you would invest in for a growth potential. So if this is right now at 174, your expectation is that by sometime in the year, this should move to 200 or 200 and above that range. Now, the market cap on this is at 2.78 trillion. So this is a leader. Everyone and anyone has some stock in Apple right now. So that's a good sign that everyone's invested in the market as well. Now, it's not just the fundamentals, but there's also a lot of product launches that are supposed to happen sometime in the fall of 2022. So this would mean new iPads launching, new MacBook Pros launching. So there's a lot of momentum that would then cause the stocks to then rise as well towards the latter part of the year. So that's a good sign. So now that we've looked at the basic fundamentals, let's dive a little more into the earnings and see what they have in store. So the earnings for Apple is fairly good. It's beat expectations quarter after quarter, and even now the last quarter release, it has beat it by 0.21. So that's a very good sign. That means it's a healthy company, not just by the brand that it portrays to everyone, but also the fundamentals look strong as well. Now, let's also look at the momentum of the stock. So has the stock gained in price year after year? So to analyze that, let's compare and see what would the stock perform in comparison to the S&P 500. The S&P 500 is a benchmark that we look at. So if you look at Apple, which is in orange, you will notice that it actually supersedes or outperforms the S&P a lot. So the S&P 500 would have been around 20% right now. Apple's already plus 30% right now. So that's a good sign. That means that when the market moves up, Apple will exceed the S&P benchmark. So that's a good sign as well. So now that we've looked at the fundamentals, let's look at the Apple technically and see, is it a good investment for us? So Apple did decline over Q4 of 2021, and it was a significant decline. But since then, it has rose upwards. Now, if you look at it more closely, let's look at the last earnings that got released. So you'll notice that the estimate for earnings was at 1.9 and the reported earnings was 2.1. So it did beat the earning estimates, which is a really good sign and a sign for healthy stock. So since then, it has moved higher and higher. And it's kind of around the mark where there could be possibly a slight correction in store for it. But that's just a short-term correction. Once it corrects a bit, it's then going to just go ahead and meet its all-time high. So this is a good stock to invest in not just for like a short duration for maybe half a year, but this is a long-term investment, and you're getting this at a discount where the market stopped falling down, but it started to rise higher as well. So that's my summary for Apple. Apple's my number one pick. Go give it a try if you like or want to invest in this, and try and see how this would fare in your investment portfolio. Now, the second stock that I have on my list is Nvidia, and this is another technology stock that I recommend for February of 2022. And the reason why my recommendation is for Nvidia is that with the recent developments in the graphics card sector, with mining being so prevalent these days, and also with the metaverse and the virtual reality scene that's taken forth, Nvidia plays an important role to make sure this all happens. And with that, Nvidia has a good growth potential. Now, in the previous months, Nvidia was overbought. Everyone was invested into the company, and that's where we saw such a huge decline. So it was impossible to buy it at such high valuation. So now buying it at a discount seems to be a good price, because once it moves higher, it's going to be impossible to get into the train of buying Nvidia at that point. So let's analyze it fundamentally and see, is it just fundamentally sound, and is it technically sound, or is it just look good on paper and everyone recommends it? So let's analyze this a little more. So let's start by looking at the basics of Nvidia and see if it's a good buy for us. So the first thing that we look at is the earnings per share, and it's stated at 4.33 right now, which is fairly good. Anything plus 0, plus 2 is a good sign, and this is a good investment that you should be part of. Now, the price to earnings ratio is at 56. Now, this, in my personal opinion, is a little high. Shouldn't be so high, just because you want something that's in the 9 to the 20 range, and that's the average for a growth stock right now. But there has been a lot of upward PE ratios that we've seen in the last few months, with everything going up, people investing so heavily in it. So even though this is at 56, I still feel that technically there is strong momentum, and it's a good potential to buy it at these rates. The dividends yield for it is 0.07. Again, this is not a dividend stock. Nvidia is not going to give you any money for buying it, because they know that they're going to skyrocket and do a lot more in terms of growth in the coming months. They are investing all the money that you put into it into innovations, R&D, and just to get better and better, and like invest it into infrastructure and a lot of those different assets. So giving money back to their shareholders is not their top priority, and that's not one of the reasons why you should invest in it. I will make another video for the top value stocks that you should buy for good dividend yield, so stay tuned for that as well. Now, the market cap is a healthy 571 billion, so that's way higher than the average. So a good large cap stock or a mega cap stock that you could purchase for the price as well. So a lot of news articles on Nvidia, and a lot of like growth potential in store for it as well, with the recent rise in all the sectors that I talked about: the metaverse, the virtual reality scene, and the graphics cards that are doing so well, and they are the leaders in the graphics card industry. So that's a good sign as well. Now let's quickly look at momentum. So Nvidia, if you compare it with the S&P 500, you can see this is where the two separate each other. So if you had to invest in the S&P 500, you would have got an average return of 16%. Nvidia performed at 68%. So that's where the difference is in investing into a stock versus an index. Now, if it falls down, these stocks would definitely fall more, but that's where you should have good stop losses to cut your losses and make sure that you don't overinvest your money and balance your portfolio out as well. So that's a summary of the price returns versus the S&P 500. Year over year too, it's been performing pretty well. In a 3-year period, it's had a return of 581% compared to a small 66% return in the S&P 500. So this is good growth potential. It has the potential to really double your money or triple your money, or in this case, it's 5 times your money in a 3-year period. So good stock, healthy stock. But it's not just looking at the the performance of the stock, let's also look at the earnings potential and how it's performed there as well. So it's beat earnings every quarter from 2021, and it's also slated to beat in Q2 and Q3 as well. So again, good signs there for Nvidia, and it's also got more demand than the supply right now, which is also a healthy sign as well. So now that we have looked at all the fundamentals, just high level fundamentals of it, it seems like a good sign. Let's look at the technical and see, does the charts also match what it has on paper in the terms of fundamentals? Now this is Nvidia on the weekly time frame, and as you can see, the earnings just got released, or it's actually coming up now. So it's on the 16th of Feb. So it's coming up soon. So there could be a good growth potential, and it's supposed to exceed expectations of the estimate. So that's another good sign as well. Now, this is the weekly chart that we have, and if you look closely, it has maintained or stayed above the 50-day moving average. So it did just decline here, and a lot of the smart investors would have jumped on this opportunity, because if you look in the past, now this is all the way back, how many times has Nvidia touched the 50-day moving average line in the past few years? Now in the term of March 2020, it just barely touched it, and it then just like went up to the moon. And this is just the second time since March 2020 that it has touched it. So a lot of the investors have taken opportunities in. There is still a lot of growth potential. So my recommendation would be to invest now and invest early before it touches. So if it touches the yellow, which is a 20-day moving average, there is a potential that it may either turn down a little bit or move up. So my recommendation in this case would be to buy now and set a stop loss. So set a stop loss, maybe either if you have a good risk potential, either at below the 50-day moving line, or maybe around here, so 229 or 215, depends on your risk tolerance. Now I do see upside potential in this. Maybe it won't just go up like a rocket all the way to the top, but there could be some hindrances around this line, but if it breaks it, it may go up. So just be careful, but I do see a lot of growth potential in Nvidia. So that's my second pick for the day. Now my third pick for the day is Broadcom, and this is again another technology stock that I have recommended for you. And the reason why I'm recommending so many technology stocks right now is the recent decline in the technology sector. And with this decline, a lot of the technology stocks now are available at a discount. But with so many to choose from, the Nasdaq by itself has over 100 technology stocks. So how do you pick the top stocks to trade? So this is where I recommended 7 stocks for you. Not everything's in the technology sector, so this would be one of my few top picks in the technology that I personally also invest in. So that's why I'm sharing this with you as well. So Broadcom specializes in the semiconductor space, just like Nvidia, but it does a lot more than just like generic semiconductor manufacturing and supply. So let's look more into the fundamentals and see if this is a good stock for us. So now let's look at the fundamentals for Broadcom. So Broadcom has an earnings per share of 33.12, which is the highest we've seen from the top 3 that we've just reviewed. And that's a good sign. That means that it's not just twice the earnings, but it's 33 times, which is a really good measure. Now, the PE ratio is at 17, so that's good value for your money. Remember, I did say 9 is what I prefer, but it's very hard to find good companies at 9 with also a very high growth potential. Now, the dividend yield is at 2.8. So again, if I was to pick the 3, Broadcom does meet all my criteria, because it will also give you some kind of a dividend yield of 2.8% on, I'll have to check what's the is it monthly, quarterly, or annually, but 2.8 is still like 2.8 for doing nothing, just investing and also getting a lot of growth in the stock as well. The market cap is at 231 billion, so it's much lower than the last 2 that we've seen, but it also has so much more growth potential in terms of a discount that we're getting the stock at right now. Next, let's look at the profitability, or this is the performance of the stock. So in a 3-year span of time, Broadcom has returned over 100% returns. In comparison, S&P did 66. So it's not growing at that rate as Nvidia. Nvidia was like 500%. So Nvidia is like, doing extremely well for itself. Broadcom's a little lower, but it still has like a healthy 100% return. Now, this is where you could actually analyze and visualize how does it perform. So right now, Broadcom's at 30% versus the S&P is at 21%. So it's doing pretty good for itself. It's still higher than the S&P 500, which is a good sign. Now, something to keep in mind is the big decline that you've seen in, say, the last quarter that we just went by. When they fall down, they did fall down hard as well. So stop losses are important. There is a lot of growth potential, but if they fall, they do fall hard, especially in the technology sector, because if one falls, everything falls with it. The last fundamentals that we will analyze is the earnings versus the estimate. So it's performed pretty well. It's beat expectations quarter after quarter, and that's a good sign. That means it's a very healthy stock to invest in. And I'm not saying this from like invest for like just a quarter, but this could be a long-term investment to add to your portfolio as well. Now, something that I'll recommend is diversifying your portfolio. So don't put everything into the technology bucket just because I've recommended 3 technology stocks to you. You can diversify, put something into a few other sectors that I have coming up as well, so that if one sector falls down, you just don't lose your entire portfolio. So that's something to just keep in mind while you invest and create your own portfolio as well. Now let's look at Broadcom technically and see if this is a good stock to buy based on the technical analysis. So if you look at Broadcom, it did touch the 50-day moving average line. And since touching the 50-day moving average line, it's now moving higher. Now, it did break. Now, this is the weekly time frame, so it holds true, strong to its values and the support and resistances that the moving averages have for it. Now, it did break through the 20-day moving average line and it's heading higher. So that's a good sign. That means whatever resistances were there, it has broken it, and there is upward potential in store for the stock. And again, just like Nvidia, you would see that rarely ever does it touch the 50-day moving average line, except for March 2020. So if you compare March 2020, I wish I could have time to do an overlay of Nvidia on top of this, but they perform very similar, except for the drop year where it actually did go below the 200-day moving average line and then bounce back. But it never has touched the 50-day moving average line since, and now that it's touched, it started to move up again. So it's got strong momentum. It has a strong growth potential as well in the coming years. So if this is something that I would invest in 2022 and just keep it for a little longer, there is strong growth potential in your portfolio by investing in the stock. Now, the 4th stock that I recommend to you is Home Depot. Now, if you live anywhere in North America, you've probably seen a Home Depot somewhere, and it's a common stock with so much of renovations happening, so much of construction happening. Home Depot is thriving. So let's look at the fundamentals and see, does the fundamentals make sense? And then we look at the technicals and also analyze that as well. So we'll start off with the basics for Home Depot. The earnings per share is at 15. That's pretty healthy, more than the 2 that I would recommend. The PE ratio is at 23. That's pretty good too. Like, it's a good deal that you're getting it for 23 when everything else is like so high. The dividend yield is at 1.8. So don't expect too much from Home Depot. This is a growth stock. So 1.8 is still a good discount. You're getting good growth, but at the same time, you're getting some money coming into your account as well. So that's a good sign. The market cap is a healthy 382 billion. So it's again a large cap or a mega cap that you could classify it under. and it's got good volume too. Now you always want something that has high volume, because if there is some investors that are looking to skew the market and just short against it, it'll cause like a lot of volatility and fluctuation. So that won't happen when you've got over 3 million people invested in the stock and trading on it on a daily basis. Next, we look at the price performance and compare it with the S&P 500. And as you can see here, over a 3-year period, it has performed or given you returns of over 100%. So 99, that's almost 100%. And if you compare the chart below, so you can see the orange is Home Depot and the S&P 500 is the blue line that you see on your screen. So Home Depot has given you 35% more return than the S&P 500. Now, it's nothing compared to the mega Nvidia or the Broadcoms that we just saw. But this is where diversification comes in. You should not put all your eggs in one basket, and I'm sure everyone's told you that. But this is where you put some into like this sector where you would have like something that balances your portfolio, and you could also invest and skew your portfolio where you would have more or less in a more growth heavy sector or a more aggressive sector where technology could just like go up and it could also fall down. So that's an example where you could diversify your portfolio, but overall it's doing pretty well. So you could either take this or you could take Home Depot or Lowe's. They both perform pretty well, but this is just a few opinions or options that are available to you that you could invest your money in. The last thing that we look at is the earnings estimate. So it seems to be that it is either going to beat the estimates for the rest of 2022, and it's never failed it. So that's a good sign. So that means it'll prevent any major declines from happening in the stock from estimated earnings not meeting what they were supposed to be. So that's a healthy sign from the fundamentals. It has my thumbs up. Now let's look at the technicals and see if it makes sense to put your money into it. So this is Home Depot on the weekly time frame, and as you can see, it did touch the 50-day moving average line and it's bounced up. So that's a good sign. That shows you that it respects the 50-day moving average. And as you move back in time, there are very few occurrences where it actually touched the 50-day moving average line. So now this is where it touched it previously, and let's see how it performs. So it just marginally beat the earnings estimate. So that could possibly be a reason why we saw a strong decline. There could be some other news that factored into like the decline that we saw here. But overall, it's been healthy. Now, I would never have recommended you to buy it at this high levels here. But now that it's gone down, it's given you a good value for what it's offering you. So yes, I would recommend taking the stock and investing your money into it. So that's my pick for Home Depot. My fifth pick for you today is Costco. Now, if you again were anywhere in the world, now Costco is not just in North America, but they have branches all over. So this retail giant has so much of growth potential. But now let's analyze it fundamentally and technically and see, does it make sense to put your money into it? For your money, the dividend yield is at 0.63. Again, this is not a dividend stock. This is just for growth. The market cap is a healthy 218 billion, which is also good, and good volume of 2 million stocks traded daily. So that's a good sign. That means that there's a lot of people buying and selling the stock on a daily basis. Now, as we look at the price performance, you could see that Costco in a span of 3 years has given back returns of 141%. So that's a good sign. That means like it's outperforming the S&P 100. So if you do a year-to-date comparison, Costco right now is at 43% and the S&P is at 21%. So that's a growth potential, and you can see the big division in how the Costco's actually overperformed over a span from September to December of 2021. So that's where these growth stocks can outperform the average of an index, and it's one of the good investments to put your money in for a long-term investment, because the retail industry is not moving anywhere. There's still a lot of demand for basic supplies, and also the discounts that you get at Costco is what drives customers back to it on a daily basis. The last fundamental that we'll look at is the earning estimates, and as you can see, the Q2 of 2021 is when we Costco did miss their earnings estimates, and also the Q1 of 2022 it just missed it by 0.09. Now, is this something to get worried about? In my opinion, I think the market did correct itself to make sure that these earnings or miss outs in the earnings were factored into the value of the stock. Now, this is the Costco technicals that I have on the weekly time frame, and as you can see, there was a significant drop in price in the last quarter of 2021. Now, since that time, the market has corrected itself and it started to move upwards. So generally, you would see that it would correct itself around the 50-day moving line. As you can see here, it has touched the line and then bounces back up. Now, in this case, the market has not touched the line. It hasn't touched the 50-day, but it has decided to bounce out of this mystical moving average, which we really don't have it on any of our lines. So it could potentially be this where it touched the 20-day moving average line. And the reason why it has decided to just bounce out of like thin air is that there is a lot of growth potential in this. There's a lot of buyers interested in buying this at a discount. So even though it's just fallen down for 3 weeks at a stretch, the buyers feel that this is enough for me. I just need to put my money inside the market. And that's what we've seen here. It has gone upwards in momentum and it's heading higher. So this again, it's at a discount. All I could say is that this could probably, now that it's broken or crossed the 20-day moving average line, that has potential to grow higher and maybe meet its all-time high of 567 as well. So this is again another buy for me on my top picks for February. 2 more picks to go, and my second last pick for the month is Accenture. Now, Accenture is a technology service provider, and it's a company that a lot of us are familiar with. But now let's look at the fundamentals and technicals to make sure that this is a good, worthy investment to include into our portfolio. So let's start with the basic fundamentals for Accenture and see does it make sense. So the EPS is at 10.54. Not the greatest, not the worst, but it's still healthy above the 2 that we recommend. The PE average is 33, still on the higher side. I would say anything in the 20s would still be a good value. So this is a little on the higher end, but it still has a lot of growth potential that you could see over the span of a few years now. And that we'll look into more of the details very soon. The yield potential, so this is the dividend yield that you would get out of it, is at 1%. So not the best, again, but this is growing growth stocks, not just a stock that you would have for dividend yields. The market cap is a healthy 216 billion and a healthy volume of 200 million shares traded per day. Now let's look at the price performance of the stock. And as you can see, over a span of 3 years, it has returned 130%. So that makes it a strong contender to put your money in for a few years and make sure that this will give you a good return on interest. This is something you'll never get by putting your money into the bank. Now, this is the S&P 500. S&P 500, where it performed 21%. Accenture performed a very healthy 46%. It's almost double so far. So that's where growth stocks come into the picture, comparing it to an index. And the last thing we'll look at is the earning estimates. Now, as you can see, all the way from Q1 and Q2 of 2021 till now, it has beat the estimate. So it's doing well. It's actually outperforming it, which is a good sign. And that's what gives you a small edge in the market. So every time it beats it, you'll see a small spike in the price going up. And that's where you would get a higher return on your investments into these stocks. Now let's look at the weekly charts for the technicals. And as you can see, Accenture did decline like all the other stocks that we've seen so far, but it did hold strong ground to the 50-day moving average. And that's a common trend that we have noticed so far, is that all the good stocks have been holding ground on the 50-day moving average. And that means that as soon as it touches the 50-day moving average, the buyers just jump in. They know that this is a good stock that they're getting at a discount. I need to put my money into the market, and that's what we're seeing here. So I do predict that this could potentially have some turbulence around the yellow line. That's the 20-day moving average, and if it breaks it, there is a strong growth potential. So I would recommend a stop loss, but I do not see anything bad happening to the stock. If I just look at the earnings here, in the worst quarter, it did beat it, and that's where we saw a short rally for another 3 weeks after, even though the rest of the market was falling down. So a good stock, it has my thumbs up, and I do recommend you putting your money and investing in it. Again, this is all up to your discretion. Take everything with a pinch of salt, do your own research, but this is just my analysis that is recommending this to you. My last recommendation to you for the month of February is Charles Schwab. Now, Charles Schwab is a mega finance company, and it's got so many diversified sectors that it invests in or that it has a portfolio in. Now, the common one that you probably heard about is the ETFs. There are a lot of ETFs that are floating around in North America that go by the Charles Schwab brand. It's a recommended, reputable brand that I personally also invest in as well. So I do recommend Charles Schwab, and it's not just the company that I'm after, but I'm also looking at the fundamentals and the technicals to recommend this to you. So let's dive into it and see if it makes sense for all of us. So we'll start off with the basic fundamentals with Charles Schwab's. As you can see, the EPS is a mere 3.91%, 3.91. Now, if you compare it with the rest on our list, this was nothing close to what we've seen for the others, but this is again a different sector, and all the different sectors perform differently. And you would find, or you may find, some of the other finance related stocks that may overperform or may have a better EPS than what I'm showing you right now. So the important thing is to not just go on the fundamentals by itself, but also to marry it with the technicals, because market timing is also something you should factor in, because if you just buy something that's right on the top when there's a good EPS number attached to it, it doesn't mean that would continue moving up, or it may not correct itself. So that's something to keep in mind. Second is the PE. PE is at a healthy 22.42, so that's a good value. I wouldn't say this is extremely high compared to the others that we've seen on the list. The dividend yield is a 0.91, nothing to talk about. The market cap is 168 billion, so it's pretty good in comparison to the others on our list. And the volume's like a huge 9 million. So that's again, and not only just that, it's also priced relatively like nicely at $90. So it's not too expensive in comparison to the others that we have as well. Next, let's look at the price performance. So over a span of 3 years, the stock has returned 87%, which is really good in comparison to the others that we've seen in the finance sector. And again, it's all about market timing. Right now in the month of February, Charles Schwab's would be a good investment opportunity. But maybe in the month of March, there could be another finance stock. So you can always rotate your portfolio. It doesn't mean that you stick or marry a stock for life. You could always get rid of it, get another one in, and just keep a good healthy number of growing stocks in your portfolio and just getting good returns out of it. So in comparison to the S&P 500, Charles Schwab's has performed at 70%. So that's a huge gain that we've seen recently. And you could see like a big divide between the two. And it's never ever come down to the level of the S&P 500 in terms of returns. So that's a really good, healthy, strong stock in my opinion, fundamentally. Now let's look at it technically. But before we do that, one more analysis to do fundamentally, and that's the estimates and comparing it with the actuals. So the EPS for Charles Schwab's has been a hit and a miss. But it's just missing it by like 2 cents. So I would not really qualify this. So the market hasn't really reacted to the same extent that it would do for some stock that has actually missed it by $1 or more. So I would say not to worry about like these small misses. Again, there are other stocks also available, but at this time I feel this would be a good opportunity to step into the stock. But now let's look at the technical and see, does it also make sense technically to step into it right now? So this is the technicals for Charles Schwab's on the weekly time frame, and as you can see, it rarely ever falls down to the 20-day moving average or the 10-day moving average. That's the black line that you see on your screen. So even though there was such a big decline in the last month, it just merely moved down, and that shows a sign of strength. That shows that even though it's the entire markets in the entire world's falling, there is strong growth potential in this particular stock. Now, it has rarely ever touched the 50-day moving average line. So since November of 2020, it's just then gone up to on a different level, a different growth cycle, and it's just like moving up in the upward direction. So it's doing good. It's doing good. I would keep a close eye on the 20-day moving average line and the 50-day. So if ever it declines this area and it moves lower, it's a sign to exit. So that's going to be where your stop loss would be put, just to make sure that you do not buy it at a time when it's like, the end of a growth cycle. So there's still potential, but I cannot tell you where exactly it would end. But I would say that since it's like, heading up to another uptrend, there could possibly be a lot more in store for the stock, at least for now. And that's it, everyone. Those are my recommendations for the month of February. I hope you got some value out of this video and you could invest some money in it, and do share your thoughts. If there are others that you probably already just purchased in the month of Feb or Jan, and which would you recommend in the comments below. So thank you, and stay tuned to another analyst is coming up very soon.